podcast where we put you on a map. This is Ron Costa broadcasting live from the Mappable USA studios in Las Vegas, Nevada. And folks, today we all know about joint ventures. We all know about opportunity zones. Today we're going to put those two together for you. And to do that, let's introduce Vicki Hutchmala from the Coasis Marketplace. Vicki, how are you doing today?
Well, another great day in Vegas. How could I not be fabulous, Ron? We're going into the perfect time of year where we suffer through the summer just so we can get to the fall and the winter and the spring, and we love it. And not only that, but like you said, we've got another guest, one of our favorite guests, and we're going to do something different with opportunity zones and talk about joint ventures. So let's get started.
Yeah, let's get him on the broadcast again. Folks, welcome Gerry Reihsen. Gerry, how are you doing today? I said that 3 times.
I'm doing very well, thank you. Sounds like you guys are doing fabulous in Las Vegas.
Yeah, we really are. I'll tell you, it's a great time to be here. Like Vicki said, the weather is great, and it's one of my favorite times. Even though I hate Halloween, I really like the weather now, so it's a great place to be. So,
how can you hate Halloween?
I never liked it. I never got into the whole thing, even as a kid. But I'll tell you, yeah. Well, I like every other holiday though.
But I don't like it. I didn't particularly love it as a kid. I didn't hate it. I think it's fine. But I love it since I've been a parent and now a grandparent. I love dressing up those little kiddos in their cute little outfits. We put our granddaughter in my wife's Little Bo Peep costume from when she was 4 years old. So
my
passed
God.
down the Little Bo Peep costume.
See, now you should send me a photo of that, Gerry, because that would be cool.
Yeah, maybe you can kind of replace the photo of my ugly face on
that works.
Materials.
Oh man. So anyway, Gerry, listen, we've had you on a number of times where we're doing kind of like this Opportunity Zone educational series with you, and I want to continue on with that. But before we do, why don't you tell us all about, in case people haven't heard you yet, who you are and the Coasis Coalition that you guys have put up and everything else that you got going on.
Well, sure. So we discovered the Opportunity Zone statute right after it got passed, and we were blown away by it and by its possibilities from the very beginning. And we set up a number of arrangements to help facilitate others to get in the space, and also for ourselves to get in the space. We're investors, Opportunity Zone investors as well, by the way. The Coasis Coalition companies is a variety of services, consulting. We were doing conferences and events, but that kind of got dropped because of COVID, and we haven't picked it up again. We may again, but that's a lot of work. Consulting, business advice. We help people set up funds and fund platforms as business people. We've done billions and billions of dollars worth of those ourselves, including 12 billion that we in our own fund platform. But for clients, you add that all together, it's probably 20, 30, 40 billion dollars of fund platforms and investment funds. And then we also have a law firm. We actually have 2 law firms. I have my own law firm, and that law firm is of counsel to a larger. My law firm is called Reihsen and Associates, very creative name, and my of counsel to a larger national law firm called Ferguson Braswell, and that's a very good firm. And we do we do everything that businesses need, and in particular, my area, besides being a general securities and corporate and M&A and other lawyer, I have a strong focus. It's kind of consuming most of my time in the Opportunity Zone space. We represent clients, both consulting and legal, from the whole panoply. We also have a relationship with a broker-dealer to raise capital for Opportunity Zone funds and Opportunity Zone joint ventures that we're going to talk about today, and just generic other fund-raising activities. So that's all that we do. We watch this space we'll watch this space in a month or two, because we're looking at putting together another fund platform from our perspective. So,
well, this is why people really need to listen to our podcast, Vicki, because we speak to the right people. Absolutely, right? Is there anyone better to learn from than Gerry? And the answer is probably no. So that's why we do it. Yep. And so Gerry, listen, we talked about at the top of the show now. joint ventures, opportunity zones. This is something that not a lot of people are talking about, but maybe we can get some kind of insights from you as to how this is all working and what the market's looking like and really what it is to begin with.
Well, so when we were talking about joint ventures in particular right now, joint venture can be obviously for anything, for any kind of business or company pursuit you want to pursue. But the type of joint venture that is predominant in the opportunity zone space are joint ventures for the development of a parcel of commercial real estate. And so that's what we're going to talk about today.
Perfect.
And I think, the really interesting and fabulous thing about the opportunity zone ecosystem is that it doesn't change any market behaviors other than to encourage investment in certain areas in a certain manner. So basically anything we can do in business, we can do as an opportunity zone arrangement if we care to. So maybe the first thing I'll mention is kind of what is a typical real estate project joint venture.
Okay.
So they're all across this country and the world for that matter, but we're very aggressive real estate people in the United States. All across this country, there are persons and businesses whose business is focused on acquiring and developing real estate. And you have these parties tend to focus in certain areas. One might focus on multifamily / apartment housing. One might focus on industrial. One might focus on office space. One might focus on residential single-family homes, et cetera. And some have multiple focuses. But any of those, if we can appropriately attach them to an opportunity zone, one or more, and opportunity zone arrangements, can be done as an opportunity zone deal. And those parties out there who are developers tend to be of two types. One is called a fee developer, and a developer is kind of like a producer of a movie, right? They're the ones who get everything arranged so that a property is acquired, a property is financed, a general contractor generally is contracted, subcontractors are vetted, draws are organized and paid from your construction loan. So they're generally not the people who get in and turn a shovel. They're the people who take care of all the arrangements at the high level, kind of like a producer of a movie. Is not the director. He takes care of all the arrangements at a high level. So the way it works is these developers identify a property that they think that they can build a profitable real estate development on. And if they're a fee developer, they want to be paid a fee for that and then walk away and leave it to either the person who owned the property or the person who invested in the property to carry on thereafter. Fees for developers are generally around 4% of what you call hard costs. That means the cost of the property, the actual cost of construction, but not a lot of the kind of financing fees and things like that. Then there are also fee or fee plus investment developers who either take a fee or not, and it's not uncommon to take a fee, and invest a piece of their investable cash in the deal and have a piece of the upside. Okay? And generally, the arrangement for both of those, and by the way, the developer fee is usually the same regardless, because to get the investment by the developer, they got to come up with some cash to do it. Sometimes they're taken out, and that's called a carried interest when they leave, because it's carried without having money left in the deal. Sometimes it's called a promote. That's usually used when you still have money in the deal as the developer, generally as the general partner or the managing member. But in either case, both developers expect to be able to fully liquidate and monetize their arrangements when the property is completed, the project is completed, and it's leased up. Generally, somewhere between 85 to 95% of occupancy is considered to be leased up, or sometimes the word they use for that is stabilized. The property is stabilized. So there's no reason why you can't do that under the opportunity zone structures and allow the developer and or the investors in it to take advantage of the great opportunity zone benefits, which includes tax-free upside after 10-year hold, except the 10-year hold, right? When developers, and many developers think they can't really play in this space because when their model is to do a project and then get it stabilized and walk away with their payments, they think they have to stay in the deal for 10 years, and that's a problem. And sometimes that is required by the investors, but there's plenty of ways to get around it. Now, that's the general structure. Let me stop there and see if you guys have any questions.
Yeah, I do have a question, Gerry. It sounds as if from one of these fee developers' perspective, they don't really care too much about the tax incentives then for the opportunity zone benefits, do they? Or are they're just going to walk away?
That's really a perceptive question, and it goes to actual, just as you've identified, it goes to kind of the structural dynamics of these arrangements. Usually developers, as you may recall from our other podcasts, to get the advantages of the opportunity zone program, you have to invest capital gains into whatever you're doing. And those capital gains are the investment that gets, among other things, the tax year upside after a 10-year period. Well, interestingly, developers rarely produce capital gains. And if they do, they tend to distribute them out quickly to make other investments. So for instance, if you're it depends upon the deal and it depends how long you hold it. But if you're like a home developer where you're selling off lots or selling off homes, that actually produces ordinary income, not capital gains. So from one structural perspective, developers often have a tough time even being able to themselves access the benefits of the opportunity zone program. It's still possible if they have capital gains, and if they do projects that they develop and then hold on to for a while, which is often the case when it often takes a year or more to stabilize, for instance, the multifamily apartment complex, get it up to around 90% leased. So that can produce capital gains depending upon the arrangements. But, it is very often that developers themselves personally don't care or can't access the opportunity zone benefits. And of course, even if they did have the capital gains, if they're exiting in less than 10 years, well, they're not going to get the upside benefit, a tax-free upside anyway, right? So some developers, I think, unwisely think that they should really not even bothering to look at the opportunity zone space. And I'll tell you why I think it's unwise. The reason it's unwise is the lifeblood of a developer is the ability to do development deals, do projects. And you have literally a line going around the block of investors that have capital gains that would love to be putting their capital into opportunity zone projects. And if you're a developer who says, hey, I don't really see how this works for me, then you don't understand that you are ignoring a huge and highly motivated capital channel for your projects.
Oh, absolutely. Absolutely.
Well, not only that, but if you do the development, that's just another, another thing under your belt. You have another project there, and then you're successful. That creates a reputation. So you're right. There's no reason why they wouldn't want to do it. But another question to piggyback on that is, if you do a joint venture with a fee developer, your entity still has to be in an opportunity zone fund. You still have to create the fund itself, right?
You have to create the appropriate structure vis-a-vis those parties who are seeking to obtain the opportunity zone benefits. That's true. And while technically or not grammatically, but whatever, the statute does call it a fund. again, it can be just an enterprise or enterprises owned by a very few people who are the investors and the developer. And the developer, by the way, doesn't necessarily have to have an interest, especially if you're a fee developer, doesn't necessarily have to have any interest in the actual project if they're just being paid a fee. They can just have a contract. But, predominantly, well, there are fee developers like that, and that's fine, and it produces nice income for them, regular ordinary income. Predominantly, they'd like to be able to, and in fact, it makes sense for the investors to want to have the developer have some stake in the success of the project by having them get some kind of payment as a result of a successful completion and lease up of the project at the value that was created. So, yeah.
Well, does in this scenario of opportunity zone joint ventures, does it matter or make a difference if it's a commercial project or a residential project being developed, as long as it's in an opportunity zone?
No, I mean, and in fact, it doesn't even have to be a real estate thing. It could be some other kind of, could be a restaurant in an opportunity zone that you structure as a joint venture. It could be a tech company, although they're usually structured in a different way, but it could be that way. But no, you're right. When it comes to real estate investing, and there are those out there doing single-family residential homes. On the investor side, they would be looking to create a full development, 100, 200, 300, 400, however many, 10, 20, 30 homes, that it will be part of a very rapidly growing, I wouldn't say new, but it's newly institutional asset class in real estate called build-to-rent residential homes.
Right. The new trend.
And they would rent those out for 10 years to then look at seeing if they want to then start selling those to homeowners tax-free.
Mm-hmm.
Now, let me ask if there's any more questions before I get to some of the techniques and some of the opportunities vis-a-vis opportunity zone joint ventures.
Yeah, let's move on. That sounds great.
Okay. So when it comes to some of the techniques and the opportunities doing real estate development joint ventures in the opportunity zone space, as I mentioned, for a couple of reasons, many developers have turned off from the space. And one of the things that turns them off is they say, look, it's not in my business model to hold on to an investment for 10 years. I want to build, stabilize, take my return, and move on to the next thing. And that is a very serious objection, because often, if not always, a developer with that model has a set of employees that depend on and expect to participate almost as investors themselves, but generally through bonuses and whatnot, but sometimes as co-investors, in that dynamic where, hey, we're going to do this project, we're going to bust our buns to do it right, we're going to do it fast, we're going to make sure it's done on budget, we're going to make a return, that money's going to go in the pocket of the developer and its employees, then we're going to go on to the next one. Well, it is a mistake to think that you can't replicate that model in the opportunity zone space, even though you have that 10-year hold. And the way you deal with that is something called crystallization. Crystallization can take a number of forms, but what it basically means is that, look, I'm an investor, I want a joint venture with a good developer to do a project. And I understand that to get a really good developer, I often need to get somebody who is not going to be my co-investor for 10 years. They're going to develop a great project. They're going to stabilize it. They're going to take their fee. They're going to take a little piece of the upside on stabilization, and they're going to go. So how do I deal with that? Well, what crystallization essentially does is it either does a valuation, or it goes through some process to value the joint venture's project on stabilization, and then the joint venture will take out the developer at its return as though the property were sold at that time. Sometimes, and usually there's enough value created that the property can be refinanced at the higher value created through the process of creating this new development project, that it can go refinance and get a new loan from a lender, a permanent loan that leaves enough left over to pay the developer's piece of the upside, and maybe even have, and you usually even have some left to be able to make a distribution out to the opportunity zone investors. And although that's what's called a cash out refinance, where you refinance and then send the cash out to your investors, although technically you have to wait at least 2 years from a opportunity zone investors before you send them cash out. But usually it's going to take 2 years to get a project done anyway, so no big deal. So that is the main mechanism that can accommodate a knowing developer, a knowledgeable developer, to do deals like this without disrupting that developer's usual business model. Any questions about that?
Interesting stuff. Go on, Vicki.
Exactly. That's really interesting, and like you said, new things and things that are so creative, like opportunity zones and the potential within them and what you can do. A lot of times it requires a kind of mindset change, so that with developers, develop it, get in, get out, get my fee, go to the next project. But in this scenario, you kind of have to change the mindset to see, well, maybe I don't need to get out so quickly. Maybe I can make more money or get better benefit if I stay in a little longer, which is why it's so important for Ron and I to do these podcasts to educate people on the potential. Because opportunity zones, when they first came out, it was like, oh, okay, well, let's build an apartment. We'll get some real estate. We'll go in an opportunity zone. We'll build something. We'll get out. But nobody ever thought of joint ventures at the time. People didn't even know whether you were in the real estate business, the banking business, a financial business. People didn't even know what opportunity zones were, much less what you could do with them. So what you're doing, Gerry, is just great, because you're taking it way to the next level, showing us what we can do creatively.
And we did a podcast on this about 6 months, maybe longer ago, where basically I was a little bit cheeky about my statement, but I was basically saying that professionals and others who haven't thoroughly examined the Opportunity Zone program and how it can apply to them are basically committing malpractice. But
exactly.
I mean, that's a bit much, but there is so much you can do in this space. Now, let me tell you something. It was an interesting experience that I've had with my developer clients, both business and legal, is that I have found that as they do these Opportunity Zone deals, they start off wanting to follow their usual pattern where they develop, complete, stabilize, and cash out, but they are selectively staying in some of the Opportunity Zone deals. So to the extent that they can, they can afford, that their cash needs can allow them to, they're saying, hey, you know what? I want to stay in this deal for 10 years, whether I am taking advantage of the Opportunity Zone benefits or not, because I like where this is going to go, and I think it's going to have a lot of, even a lot more value after 10 years. In those cases, we usually try to structure in a way where the developer is also getting the Opportunity Zone benefits, but we've had clients that are staying in the full 10 years that are developers. It kind of along the lines that you just said, Vicki, their mindset has changed a little bit to see kind of the benefits of long-term value.
Then who knows where it'll go from there, because every mindset change creates a new opportunity or potential, depending on how creative you are in what you want to do or what you want to accomplish or what you can see has been accomplished. And again, it always goes back to You need the right advisors and the right consultants to help you to get there, to help you realize the possibilities. Well, so Gerry, let's go into the difference between a regular opportunity zone fund and a fund that is a joint venture. Is there anything different between the two, or anything you have to do specific to one or the other in creating the vehicle and setting the fund up?
Well, so a joint venture usually implies two people or just a very few number of people. While I think what you're alluding to when you're saying an opportunity zone investment fund, you're talking about a fund that is actively going out and soliciting investors in their numbers. Generally, sometimes I like to keep it under 100 people for technical legal reasons, but, maybe tens to dozens. And if you're a certain type of fund, as many as you want. There is a public opportunity zone fund that has, I imagine, tens of thousands of investors, maybe hundreds of thousands by now. So there are very significant differences between joint venture arrangements and fund arrangements. I mean, the joint venture arrangements generally are done legally and business-wise over professional but brief business plans and financial projections, which are shared with a very few, might go to maybe a dozen, likely usual suspects who invest in these kind of things and show them projects. You go to those who, have an interest in your type of project, whether it's industrial, office, residential, whatever the case. And you'll make the case that, look, we're a quality developer. We've had a good track record. Here's the returns we think we can achieve. And you'll pick generally one or maybe one or two of those investors to joint venture with the developer. When you're setting up a fund, depending upon your capital access approach, you will at the very least be creating a prospectus or offering memoranda so that unschooled investors, unlike the type of investors you're looking for in a joint venture arrangement, who are generally very, very experienced in their space and are institutional in quality, but so unschooled investors have all the information that they could possibly need, as is reasonable to a reasonable investor, to make a good investment decision over investing in that fund. It includes a description of the fund strategies, obviously a description of the fund terms, how it distributes its returns, all the risk factors that an investor should take into account, go through a subscription process. You either make sure it's an exempt offering that does not have to be registered with the state or the federal government, and you file a notice form called a Form D to give notice to the government that you're doing this non-registered offering. Or, as we have a few, you do a public offering where you register with the Securities and Exchange Commission. You go through a 6 to 12 month process with them to vet your prospectus. If you're going to be listed on exchange, you apply for listing on exchange. You still have that document. The document is the same kind of document, a little more thorough, but the same kind of document for disclosure of all things to investors. So when you have a joint venture agreement, you basically just have a joint venture document. You have a development agreement. You might have an investment management agreement. You might have an acquisition agreement, a purchase agreement for the property. Pretty simple in comparison to a fund that's going into the space.
Okay. I believe that the pending legislation is going to allow opportunity zone funds to invest in other opportunity zone funds. Is that correct? That they're looking to allow that?
That is what the legislation says. Yes. Interestingly, about somewhere between 6 and 10% of the people who've created opportunity zone funds invest in other opportunity zone funds, which is not legal, or it does not comply with the the statute already. So this would correct that for a bunch of people.
Yeah.
But between you and me, Vicki, if that passes, the creativity that you can undertake, even in a private context, will go off the charts. And I've got a deal right now I'm working on that. If I had that, if I could do that now, it would be amazing. Now I want to go back. Before I go back and mention something I want to mention, and just make sure that I'm not leaving any questions off the table.
No, this has really been good. Actually, I've been taking notes as we go along, and my wrist is starting to hurt.
All right, let me go back. Let me go back and talk a little bit about the investors who do joint venture investments in opportunity zone real estate development projects. So there are a class of institutional type, what you would call real estate private equity firms, and they're always looking, and they raise investment funds of their own, and with that capital that they manage and they get their fees for, they go out and find best-in-class developers to invest in their projects. So these groups might invest in, a half dozen to a dozen projects per fund that they put up. And they'll do fund after fund after fund. And they're unique funds. They're not like hedge funds that invest in stocks and bonds and whatnot. They have a lot of liquidity, and you might expect a fairly short turnaround of 3 to 5 years before you're expected to liquidate the fund. These funds have a much longer term focus, maybe 7 to 10 years in general, where projects are developed because they take their time, and then returns are reaped. That's the right word. Anyway, so some of these institutional investors have been wise enough to set up their own opportunity zone funds to invest in opportunity zone projects. Interesting. So when going back to your question about the difference between a fund and a joint venture for a project, my clients in the development world, developers, are often dealing with institutional level fund managers who have created their own opportunity zone fund to invest in these projects. And when they do that, that fund is actually, if you recall from our previous podcast, the general structure for an opportunity zone arrangement is you have something called a QOF, or Qualified Opportunity Fund, and then it operates through what's called a QOZB, Qualified Opportunity Zone Business. The Qualified Opportunity Zone Business has no special tax filings with the IRS. It just has the usual tax filing, usually set up as a partnership, so it has the usual partnership tax filing. The QOF has one special filing called a Form 8996 that says to the IRS, we're a qualified opportunity fund, and we are this year, we're the next year, we're the next year, we're the next year. They keep filing that. The QOZB just has to exist in the correct way to be compliant vis-a-vis the opportunity zone structure for the QOF to invest in. So when one of these institutional fund firms, real estate private equity fund firms, decide that they're going to set up their own fund, the structure is generally that instead of the joint venture investment partner investing in a QOF, the joint venture investment partner invests in the QOZB, and then the developer has its interest at that QOZB. And if it wants to get the benefits of the opportunity zone, it creates its own QOF to invest in that QOZB. The interesting thing about that is if you're a developer, you don't really have to worry about opportunity zone compliance if your investor has their own fund and maintains that compliant. All you have to do is, and it'll be in your joint venture contract, is comply with your joint venture contract as to how you operate, which is really not that problematic. It's really quite easy for a real estate investment project because it's right there, fixed in an opportunity zone. Compliance is not an issue. So it's actually, that's another big difference between setting up a fund in setting up an opportunity zone joint venture is that if you're somebody setting up a fund, you have a lot of extra compliance that you have to do vis-a-vis the opportunity zone statute. But if you're setting up a joint venture, you can, as a developer, you can avoid almost all of that compliance arrangements.
Exactly, because you waive the liability to somebody else who's the actual manager of the fund.
That's right, at the fund level. Now, the other thing I want to say about that, go ahead.
I was going to mention, I said, after hearing this so far, Gerry, before we close this out, this sounds like old-time real estate and business is like playing checkers, and opportunity zones is playing chess in a way, because you have all these strategies that you can take advantage of. But why don't you finish your last point before we go?
Yeah, so my last point is this. So as we have done these opportunity zone developments, we have found that some some real estate private equity firms do not have an opportunity zone fund. And so they say, yeah, I know we're investing this, and to tell you the truth, especially if you're a developer that isn't trying to take advantage of the opportunity zone benefits, I mean, you don't care if you're doing a development in an opportunity zone that doesn't get the benefits. It's like any other development project. And those developers and those investors have said, hey, forget about opportunity zone compliance. And I think that is very unwise. And I'll tell you why. I think that even if you are someone who's not going to directly access the benefits of the opportunity zone program, you should still set up your arrangements so that they can. And here is why. Once you set up an opportunity zone arrangement correctly, then any subsequent investor or purchaser can purchase with capital gains, and they will get the benefit of the opportunity zone program upside, meaning that even if you're not directly going to access the benefits of the opportunity zone statute, if you set it up in a way that someone else can, when you want to exit that project, you're going to have an additional class of potential purchasers who will pay a much higher price than a regular purchaser, because that additional class of purchasers is going to get a tax-adjusted advantaged return. So it's really foolish, in my opinion. And I've had clients that I couldn't convince they were being foolish. It's really foolish that if you, for just a few clauses and some compliance in your joint venture arrangements, that you don't do that when you can, when you're developing a real estate project in an opportunity zone.
Yeah.
Well, yeah, because you don't know what's going to come up that you haven't thought of, or a new opportunity that shows its face that you didn't have before. But why wouldn't you set up everything to do anything that was possible, whether you can or not at the beginning? Who knows what's going to happen halfway through or towards the end, and you've already got it set up. That's just being forward thinking.
Well, and exactly. And remember, there are very broad-based opportunity zone investment funds that are constantly looking for investments. What would they like more than anything is to be able to get a project that they don't even have to develop. It's already done, and it's still compliant. There's even a public opportunity zone fund, and they're going to be going around gobbling up these things. You're just foolish that if you have a chance to set up as an opportunity zone structure, that you don't. You should always do that.
Yeah.
I think you just came up with the new topic for the next podcast, Gerry. Ways to tell your client that they're foolish. Wouldn't that be a great point?
Well, unfortunately, I don't seem to have a problem with that. I'm one of those people who gets these. I'm one of these people who gets this kind of backhanded compliment that I'm excessively honest.
Yeah.
Well, I would prefer excessively honest than let's do shenanigans under the table.
Yeah. And of course, we're going to continue this series of opportunity zones with you on a few more podcasts for sure. But until then, Gerry, how do people get in touch with you? What's the best way?
So I don't know. Maybe I'm foolish, but I just give out my cell phone because I don't have a problem. Unlike my wife, I don't have a problem not answering a ringing phone at that I don't know who's calling. But anyway, you can call me at 214-908-2009. You can email me at my law firm at G. Reihsen, that's my first initial and last name, at swordshieldlaw.com or greihsen at fbfk.law. And for the consulting side, it's just Gerry with a G at Coasis Coalition, one mushed together word, coasiscoalition.com.
Well, I'll tell you what, we live in a crazy world because I just did a Google search under crystallization, like you talked about earlier, and it came up with Breaking Bad episodes. So something. So Vicky,
yeah, be careful with words.
Vicky, you want to close it out with a comment?
Yeah, well, so maybe that's the new thing. Instead of being paid off in cash, you get paid off in crystallized meth.
There you go. You know, this is great. I love this series that we're doing with Gerry because it just provides a little more, takes you to the next level in understanding the full potential of opportunity zones and how you can actually make them work for you instead of opportunity zones the other way, you know. And I like this idea because the reason I brought up the legislation was because I'm thinking if that would pass, you could have opportunity zone funds joint venturing with other opportunity zone funds to do incredible projects and develop just it's exponential once that happens.
Yeah, I mean that in the regular world has plenty of fund-to-fund type investment arrangements.
Right.
In fact, there are things called funds of funds that invest in other funds, and other kind of private, more structured things. You're exactly right, Vicki. That it will. I mean, business people with any experience and a nimble brain can come up with all kinds of things.
Exactly, and especially if they have someone like you, Gerry, to help them to be creative and help them to, you know, think outside the box and see if you can make more money instead of doing the same thing, making the same amount of money and just being, you know, satisfied.
And a podcast to get the word out too.
Right. Yeah.
Exactly.
All right. Exactly. Well, listen, Gerry, thanks again for being a guest on the show. Really appreciate it. This was a great episode. And Vicki, thanks for co-hosting. Folks, you're listening to the Mappable USA podcast at mappableiusa.com. If you go to that homepage, you scroll down, you'll see all our syndication sources. Just pick the one you like best, subscribe, and you'll never miss another one of our episodes. And if you want to be a guest on the show like Gerry was today, there's a guest tab there. Just fill that out. We'll see what you can do about getting you on the show. And if you like what you heard, just send us an email at info@mappableiusa.com or just leave a comment on whatever page you're listening to this on right now. So thanks for listening. Thanks for your support. We'll be again next time with another Mappable USA podcast. Have a great week, everyone.